Hi everyone, and welcome to the Q1 FY22 results for Kotak Mahindra Bank. We have with us Mr. Deepak Gupta, the Joint Managing Director, and Jaimin Bhatt, Group President and Group Chief Financial Officer. They'll be addressing the media today.
Fine, thanks, Feroza. Welcome to the quarterly earnings call for Kotak Mahindra Bank, standalone and consolidated. This is for April-June 21. Let me start with the standalone bank numbers first. We closed this quarter at a post-tax profit of 1642 crores, which is about 32% higher than what we did in the same period last year. Of course, I must say that the periods last year and the previous quarter and all have not necessarily been very comparable, considering the spate of events which have happened both in quarter 1-21, quarter 1-22, and we had a reasonably normal quarter, which was the Jan-March quarter 21. Our net interest income at 3,942 crores for this quarter, about 6% higher than what we did in the same period last year. We closed with a net interest margin of 4.6%, which was comparable to 4.4, which we did in last year as well as in the previous quarter. Our other income has seen a growth, if I look at on a year-on-year basis, by over 100%. We closed this quarter at 1583 crores, 770. Our fees and services, which comprises part of the our fees and services, which is part of the other income, got us an income of 1,169 crores, which is about 50% higher than last year. The distribution piece on this one, we earned 183 crores as compared to 144 crores last year. On a quarter-on-quarter basis, the fall in the distribution fees is largely coming in from the insurance distribution, where typically the last quarter sees a sharp rise in the insurance distribution commission, which we are. On the other parts of the other income, which we got 986 crores this year versus 632 crores last year. And if you compare this with the previous quarter, it is a small drop over the previous quarter. This effectively reflects the levels of activity which were there this quarter, which was substantially better than what we saw in April-June last year, where our income from account of processing charges, on account of new loans charges, had gone down. Credit card income and whatever have done much better this year compared to last year, though the activity levels in April-June were lower than Jan-March. Resultantly, the income compared on a quarter-on-quarter basis was lower. On other than fees, we earned 414 crores this quarter, again coming in from a variety of things, including the forex buyout and treasury income which we earned this year. On our cost side, our employee cost at 1,082 crores this quarter. Last year, during the first quarter, we had a lot of the senior management had taken salary cuts, which was reflected in the first quarter employee cost of last year. This quarter, of course, reflects the increments which we had in April, as well as the incentive payments which was paid out for the last year. Other operating expenses, again, reflecting the level of activity. This quarter's operating expenses, other than employees, much higher than last year, though lower than the last quarter. Expenses like brokerage on new loans which we got, recovery expenses or advertisement expenses were all higher than last year, though much lower than what we did in the previous quarter. Resultantly, we come to a operating profit of 3,121 crores, which is about 20% higher than what we clocked in the same period last year, which is 2,624 crores. Our provisions for this quarter at 935 crores, which includes a 725 crores provision towards advances and the balance towards investments, which gives us an effective credit cost for this quarter at 133 bps for this quarter. Last year, for the full year, we had a credit cost of 112, which included COVID provision. Without the COVID provision, that would have been 84 bps. Our Gross non-performing asset at the end of this period, we ended up with 3.56% as against 3.25% in March 21. As you all would be aware, in April and May, the collections had slowed down. We've seen decent pickup happening in June, which kind of continues in the month of July. But those slippages of collection slowdown in April, May did result in some of the borrowers slipping into NPAs during April, May. Net NPA at June 21 at 1.28% compared to 1.21, which we had as of March 21. We continue with our COVID provisions at 1,279 crores. We have not dipped into any of those COVID provisions during this period. Our SMA2 as of June 21 at 430 crores as against 110, which we had in March. A total restructure, which is including COVID-1, COVID-2, MSME, all put together, is at about 552 crores, of which COVID-1 is about 226. COVID-2 is a very small number to start with. So that's about 552 crores, which is a very small portion of our total advances. Our advances for this period, we ended with 2,17,465 crores, which is roughly about 6.6% growth over what we were at last year, which is June 20. Our growth on a year-on-year basis, we've seen home loans and LAP grow 18%. A bulk of that growth has come from the home loan segment. Our secured working capital loans in the consumer bank have also grown by 15% on a year-on-year basis. On the agri side, both tractors and the agri advances, we've grown decently on a year-on-year basis. Tractors, for example, grew 23% on a year-on-year basis, though this quarter that has slowed down by a small number. Our unsecured piece, both credit cards and personal loans, have kind of have had a slowdown both on a year-on-year and a quarter-on-quarter basis. Our SME book, which is part of the wholesale bank, saw a 15.8% growth on a year-on-year basis. We've also focused on credit substitutes, and credit substitutes increased by close to 40% on a year-on-year basis, which effectively means that the customer assets, we grew at about 8.6% on a YOY basis. Our CASA number continues to be healthy. We closed the period with a CASA of 60.2%, showing reasonably good growth for both in CASA, in CA and SA, as well as in the TD sweeps, which grew again 22% on a year-on-year basis. TD sweeps constituting another 8% in addition to the CASA of 60%, which we ended the quarter with. Our cost of SA, which was 4.22 in Q1 last year, is now down to 3.73. At the bank standalone, we ended with a capital adequacy of 23.72, including the current quarter profits, of which Tier 1 itself is a healthy 22.81. If I take the standalone consolidated numbers, we ended the quarter with a consolidated profit after tax of 1,806 crores, which was lower than what we did last year by about 2.5%. A major reason for this was the insurance company. In the middle of June, we had given a letter to the stock exchange by a profit warning that the insurance business was likely to report a loss. Last year, first quarter, the life insurance business had clocked a shareholder profit of 161 crores. We had given an estimate that the insurance business may end up with a loss of anywhere between 225 crores and 275 crores. As of June, it reported a loss of 243 crores for the quarter. This primarily comes from the sharp rise in the claims which we saw during this quarter compared to what we've seen earlier. Other than the insurance business, the other entities continued to show profits. Kotak Securities clocked 236 crores this quarter versus 169 crores last year. The two NBFCs, Kotak Prime, clocked 79 crores versus 68 crores last year, whereas the Kotak Investments brought in 71 crores against 43 crores a year ago. The mutual fund business brought in 107 crores this year versus 71 crores a year ago. Kotak Securities continues to have a pretty reasonably good market share in the cash segment, 9.6%, and an overall segment, 2.4%. Our overall assets under management at the group grew by about 32% on a year-on-year basis. Our mutual fund assets under management grew by 37%, of which equity itself grew by 61% on a year-on-year basis. The relationship value of what we advised grew past the 4 lakh crore mark and grew by about 43% on a year-on-year basis. At the group level, we end with a tier 1 of 24.11%, at an overall advances of about 2,45,000, and a balance sheet size now just short of the 5 lakh crore mark. At the end of this period, we at the group level, our net NPA at 1.34%, and we end with a book value of about 435 rupees per share. Capital adequacy continued to be very healthy even at the group level. Those are the broad highlights of this quarter. It'd be good to take questions from you.
Thanks, Jaimin. We'll take questions. We already have a few hands raised. If anybody else has any questions, just on your bottom right of your screen, there's a raise hand symbol, so please raise that. Saloni, I think you were first, so if you can go ahead, and if you can restrict yourself to 2 questions, please.
Okay, thanks, Firoza. So basically, the asset quality, if you could give an outlook on the asset quality, and is this largely because of the second wave and the collections dropping, or because of the fear of the third wave? Do you feel that there could be worry on the asset quality front? And the second question is on the credit growth. 6.6% is what you have logged, but there has been a degrowth in personal loans and the unsecured piece, which you have been cautious on. So here onwards, where do you see credit growth? And just one more information, do you have any COVID book? And if you can give that number. Thank you.
So let me just start, and then Jaimin can follow up. I think if you look at asset quality, I divide it broadly into 2 sort of categories. Yeah. Due to COVID, customers who were finding it difficult to pay, and B, customers who we could not reach well in time because of the situation prevailing, and hence they progressively moved into NPL. Yeah. So this time round, we have both categories. Now, the first category, which is customers who had less ability to pay, will take time to come back, because the business model would have got disrupted, and hence they will take some more time to come back. The second category, which is more a problem of not being able to reach to the customers and hence collect, and these are more in the form of what I call cash collection customers. They will come back as soon as, and then if you look at July, for example, a lot of that has come back to normal in any case. This time round, we see a reasonable amount of the second category, which is customers who were not able to reach, and hence, were not able to pay. The traditional customers who last time around found it difficult to pay because COVID had run for far too long, we find less of those issues this time. So this time the hope is much more. Having said that, we've not dug into our COVID provisions at all. I think it is sort of a cautionary approach. This time one wants to be more careful and more circumspect about a potential wave 3. But at this point of time, it looks pretty okay. Jaimin, you want to add to that, Phil?
Just adding one point to what Deepak said, just to substantiate that, as to how collections did impact in April, May. The worst one where we actually have to go out to pick up the cash is the microfinance segment. Now, in April and May, we saw the microfinance collections drop very sharply. As we got into June, as things opened up, you were able to reach out people, and it's continuing in July. the numbers have come back and come back very sharply. But it's very, very likely that people who did not pay in April or May are not going to pay up the entire overdues right up front. They will pay up what is due in one installment or whatnot. And somewhere that some amount of that overdue will continue, but they've now started paying up as you reach it.
So, this time it's probably looking far better than what it was last time, but it's too early at this point of time. And we must, like I said, be circumspect about the wave 3. The second part of your question really was about growth. We had sort of revved up our engine right from November, December to chase growth before the wave 2 hit. And hence, we just want to be slightly more cautious, see how it really pans out before we press the accelerator all over again.
Thanks, Deepak. Thanks, Jermin. Priyanka?
Hi, sir. So I just wanted to check. I'm not sure if I missed that number, but if you can help us with the slippages number and how much of it comes from retail and what part of retail. And since you said that there is a large chunk of customers who, you could not collect the funds from, so that is the reason why they have slipped into NPAs. Does this come from their side as well? And secondly, how is it looking currently? You did say that it is too soon to say, although it's better than last year, but do you think there will be more restructuring requests that might come in this quarter?
While Jermin gives you the number, the requests are much lesser, touchwood, at this point in time. And, we are practically at the end of July, so we've not really seen too much. Jermin did give out those numbers. Total delta requests, primarily from retail, are very, very marginal at this point in time. Yeah, Jermin, want to talk about the slippage?
Yeah, so the restructuring we've done is pretty small. As I said, all of COVID and MSME put together as at June. That's not for the quarter. The total number up to June is 550 crores, of which COVID itself is about 230 crores. So that's been a very small number. In terms of the slippages for this quarter, if you look at, the slippages aggregated to 1,500 crores or thereabouts, which is certainly higher than what we've seen in the past. And some of that came from the delayed collection. Yes, it was all over the place, but there would be areas which required us to go out and collect. For example, a host of areas like commercial vehicles or the whole agri piece showed a lot more slippages than otherwise, because those are the places where you actually go out to collect.
One of the things which underlying all of us must recognize is the corporate sector continues to behave very well. Yeah, very well. So during wave 1, the trouble was primarily with the retail unsecured. This time, because the period has been short, the unsecured retail has not created too much trouble. It's more the secured commercial, agri, MFI piece which has created the trouble. But in all this, whether it is wave 1 or wave 2, the corporate piece has behaved very well.
So just wanted to follow up on that. Is it possible to give the number for how much is coming from agri and secured loans?
There has been, the good thing about it this time, last quarter when we talked about the fact that there were a lot of slippages coming from unsecured, where you'd be worried because you don't have any security to bank on. This time around, the delayed payments have come more from the secured area. As I said, the primary ones would be commercial vehicles or the whole agri area, including tractors. So those are the areas where people have kind of delayed payments this quarter compared to what in other areas or including what they were doing in the previous quarters. So if you look at the numbers which have gone high, yes, these would be the few areas where you've seen the numbers go up sharply.
Joel, you're next.
Thanks, Firoza. I just wanted to check, sir, the other income is quite high this time. Can you give us a breakup? Is there any lumpy inflows into other income this quarter?
So two parts of this, Joel. One is the fees part of the other income, which actually has grown by 50% on a year-on-year. And actually, if you look at the fees part, we've seen growth coming across the board. You had, as I mentioned, actually, if you look at quarter-on-quarter, is a drop because the insurance commissions have dropped out. But other than that, most of the distribution fees we've seen on a year-on-year basis, a 30% growth. On the general banking fees, if you look at a year-on-year basis, you would have pockets of areas, whether it is service charges on new loans or your branch banking fees, or including commissions on LCs, direct banking fees, including credit card fees. A lot of those, if you look at a year-on-year basis, the activity levels in April, June this year were significantly higher than what we saw last year. So all of that effectively led to some of the income going up, some of which will also come with corresponding cost. Again, if you compare the same numbers on a sequential basis, some of them are actually lower than what we did last year. Then if you take the non-fees and services businesses, yes, one of the lumpy ones you could say this quarter, which we had was dividend from our subsidiaries, which came in this quarter, which wouldn't have been there last year. In the immediately preceding quarter, we had a lumpy income in the form of PSL certificates, since we had actually sold and got a decent income on that. So this quarter, we had dividend income. Immediately preceding quarter, we had PSL's income, which is part of the other.
Just want to check how much is the dividend income from this quarter, and does it always been booked in the first quarter of the fiscal?
Yes, typically booked in the first quarter. Last year, there was nothing because the bank itself was not distributing any dividend. This year, first quarter, it would be about 160 crores.
160.
At the bank level.
So this will be dividend from subsidiaries like insurance, mutual funds, etc.
That's correct. That's correct.
Okay. Also wanted to understand, sir, the 1,500 crores of slippages during the quarter. You mentioned CVs, agriculture. First of all, how high is this number? Just give us a perspective. What is your normal run rate of slippages during the quarter?
Actually, if you look at last year, the total slippages were about 5,500 crores. Okay. So to that extent, our number is on a run rate basis, slightly higher than the last year run rate of 5,500. But some of it is understandable as we kind of had lower collections coming in April and May. No point in comparing last year first quarter or last year quarter wise, because remember last year first quarter there was a moratorium period, and to that extent, a lot of otherwise what people would have slipped into NPAs in quarter one last year would not have been recognized and therefore would not be interest slippage. But by the end of the year, whether it was moratorium or Supreme Court deferral and all of that was out, and therefore for the full year, to look at, we had a slippage of about 5,500 last year.
Yeah, there were too many pluses and minuses on the slippage side. So, ideally what you should be looking at really is the credit cost, because that sort of summarizes everything and puts it into one.
No. Just to get an idea, what's been the historic run rate? I mean, my memory serves me right. It's been below 1,000 crores, right? I mean, mostly historically. I mean, discount last year, maybe this year, but just
prior period, you would say
it would be that
about 1,000 crores a quarter or something on an average.
But the flavor of the slippage is very different. Like I said, last year the slippage was different. So different set. This time it has been different.
One last to check, it is coming from.
You've gone off.
Joel, can't hear you.
Hello.
Yep.
Can you hear me now, sir? Sorry.
Yeah.
Yes.
Yeah. Sorry. I just wanted to understand in terms of gold loans, how much of these slippages are from gold loans, because that's the sense we're getting from other banks as well. That's been a major pain point this time, again, due to collection issues. Is that a big part of your portfolio? Is that a big part of these?
No, we have a very small.
Can you give us some
portfolio? We have a very small.
Our gold loan portfolio itself is extremely small.
Very small.
Doesn't really matter.
Okay. Thank you, sir.
But to look at it another way, the slippages, non-urban slippages have been relatively high. So if that answers your question indirectly.
Sorry, I didn't get that sentence.
The non-urban customer slippages have been relatively high. And then a lot of it is more to do with, like I said, reach, inability to reach customers. And they generally tend to be, the payments tend to be in cash, collections tend to be in cash. And if you can't reach the customer, then you don't get it collected.
Right.
But we don't have we have an insignificant one.
Okay. Thank you. Thank you so much.
Thanks, Joel. Vishwanath?
Hi, sir. So I understand that the points you've mentioned about slippages in detail. But when we're talking about the stress outside the NPA book, the SMA2 portfolio has risen sharply on a quarter-on-quarter basis from about 110 to 430 crore. I just wanted to get a sense, are these also, do these also follow the same reason as you had mentioned earlier? That the reach was a problem and probably now they would normalize, or were these already stressed from last year's pandemic issues?
No, so the logic is very similar. Yeah, very, very similar. Of course, you must recognize that whether it is 110 or it is 400, it's an insignificant proportion of our asset base. SMA2 is a very, very small base. But you're right, it has risen. But the reason is exactly the same.
Okay. On the unsecured lending book, now, earlier you mentioned about overall lending. You said that you will see now as the situation improves when to, really press the accelerator on lending. But just trying to get a sense about the unsecured portfolio, it's been coming down consistently. Is there any expectation that once things pick up, then you would look at it more favorably?
Yes. Like I said, we're all revved up. Just have to be doing it cautiously. And then, like I said, there is some degree of circumspect for wave 3. Yeah, so one doesn't want to be caught unaware like the wave 2 this time round. So it's engines running, but the accelerator gets pressed once there is reasonable comfort that the wave 3, if any, will not be as severe.
I might just add here, that if you look at our quarter 3 last year and quarter 4. In each of those quarters, we had grown at 4.5% per quarter, which is like a run rate of about 18% annualized. So that was what, as Deepak was saying, we were revved up and we were on that path, quarter 3, quarter 4. But yes, quarter 1 this year on the back of wave 2, yes, we did slow down.
The secured one continues, of course. Yeah, the secured one, if you see the combined mortgage one is about 80% of which, if you look at home loans per se, they would be higher than.
Okay, if I may stick in one more question on the liabilities front, sir. The current account addition seems to be continuing that pace that we saw last quarter. How are we looking at the RBI's new current account guidelines, which kick in as of September? How are we preparing for that?
Well, that is already in place. Yeah. The current account guidelines of RBI had to be implemented, and we've implemented them fully. Really. But you see, there is a mixed outcome of all of that. And generally, to summarize, the outcome of that is beneficial to some of us. Yeah, because we do manage large amounts of cash and cash management systems of corporates and SMEs, and hence, generally, we will tend to benefit.
That also helps your credit growth in general, because you would end up having to be the sole.
Well, normally credit growth triggers more current accounts. So independent variable is the credit growth rather than the derived. But yes, it helps. Yes.
Sure. Thank you.
Thanks, Vishwanath. Surabhi Prasad.
Hello.
Yeah, Surabhi, go ahead.
Yeah, hi. So in your advances, I wanted to understand, you said that home loan has seen a good growth. So wanted to understand till when do you plan to continue with the competitive rates offering for home loans, and also corporate advances continue to be muted. So if you could talk a bit on that. Thank you.
Well, we are still insignificant market share in home loans. So the so-called competitive rates will continue as long as the appetite remains. And I don't see the appetite going away in a short period of time. And then, fortunately for us, the cost of funds is reasonably attractive. So it might seem competitive from an external point of view, but from an internal point of view, it still gives us reasonably good ROEs. So I think we can continue with them for a reasonable period of time. The corporate issue is slightly different. I think on the corporate side, the rates do tend to be very uncompetitive. And, it's not just the rate, there are other costs in the structure which come in the way, and hence we have to be careful about it. And B, there is always that underlying piece of risk. You can only take as much exposure as your risk appetite, allows. Net, when you put all of this together, you get only so much growth. And then, frankly, corporates have not really been borrowing. We've still seen, negligible amounts of capital expenditure happening. Even fresh demands for working capital have been very, very low. And, the people who are really growing are already doing so well and generating so much cash that their borrowings, actually, they've been paying back. Some of these large commodity guys have just been paying back whatever they borrowed. So corporate has been muted in this whole environment. Yes.
Okay, thank you. And in terms of credit cards, could you give us a picture on how that segment is doing? Thank you.
Well, credit card is going well. Credit card has two parts to the whole thing. One is a pure payment play, which is essentially customer stickiness opportunity, because customer uses it to pay through your account and money moves through you. And hence there is a stickiness associated with that. And then there is a lending part, which is really what we call revolving part of the credit cards. Yeah. So we've been pretty aggressive on the first part, which is acquiring credit card customers at a pretty healthy pace, really, because that is not really dependent on whether COVID or no COVID. With the COVID, you just have to be careful about the second piece, which is really the revolving customers. Yeah. So the objective has been to acquire fresh credit card customers, and we're doing that at a pretty healthy pace, less focused on revolvers. So you will not see the book size increase. In fact, the book size, if you see the figures, has shrunk, but that is more the revolvers. But sheer numbers, if you look at, we've grown pretty.
Thank you. Thanks, Deepak. Poonam?
Yeah, thanks, Firoza. Thank you for taking my question, sir. So my question is on the consolidated book. We are seeing a lot of gross entries picking up even on the consolidated book. So is there any color on that front? And your CASA ratio is best in class at 60%. But as and when the bank does plan to grow, will the CASA ratio be sustaining at these 60% levels? And my third question is just relating to that, like what really led to a NIM expansion during the quarter? That's about it. Yeah.
Jimmy, you'll ever take that?
Yeah, okay. Broadly, if you look at NIM, is a combination of two things. One is at what you earn on advances and what you earn on investments. Last year, if you look at it, we had increased our investment book quite a bit. And if you look at the split between advances and investments, which go into what I call earning assets, the ratio of advances had dropped from a peak of 70 to 60. And investments, which was actually giving you lesser returns, had increased in percentage terms. As we've now seen it in this quarter, the advances proportion has gone to about 63, 64, which is a higher yielding thing than what we earn on investments, which has helped us expand the margin somewhere. So that's been there. Of course, the other thing which is most important for us is our cost of funds has been coming down quite a lot. I mean, over the last year or so, we've now got to levels where our cost of funds have been very competitive, and the 60% CASA is what is helping us. But certainly that has helped in as we got more and more CASA, which is the low cost funds. In addition to that, we have the 88% of TD sweeps, which also costs us lesser than what the normal TD does. It does help us in reducing our cost of funds pretty sharply.
By the way, I hope you're happy about the high CASA and the high NIMs. we think that's a very significant strength to run with.
Yes, absolutely. It's quite a lot of strength, and that is the reason I was asking that Is this kind of sustainable because
you
you're
see,
one of the
to
best?
some extent, if growth picks up, CASA will come down unless the deposits move. And remember, CASA is a combination of both SA and SA. Yeah. So normally the SA piece grows faster, except for the last couple of quarters. Normally SA grows faster. SA takes more time to grow. But remember, if you look at a bank like us, one of the big things which is really going to happen really is the whole government payment system is going to open up for all private sector. And I think we will be a very significant beneficiary rising out of that. It will progressively happen over the next 3 to 6 months. And that will be a big booster to SA all over again. So going forward, it may not be necessarily right to say that the CASA will probably come down. It could still remain, even with growth.
Right. So just that the question on consolidated book asset quality, because your consolidated book asset quality, there seems to be a good amount of pickup there if I compare it to the standalone book.
Yeah,
Higher. That's because of Kotak Prime.
The car business, again, similar reasons. The Kotak Prime has seen an uptick in the GNPA number there, and which is what has caused the number to go up. Again, similar reasons as we discussed for the bank.
1.28 is 1.34 or something. Is that right, Daniel?
Yeah, so the net number is about
marginally
2.4 compared to 1.8.
Yeah. All right, thank you.
Chris?
Thank you, Feroza. Hello, Deepak. Hello, Jamin. Good to see you, and I hope you're all in good health. Chris Wright from Euromoney here. 2 questions, if I may. Firstly, reported numbers appear to be showing the banking sector, most certainly including Kotak, but not just Kotak, in remarkably good shape in asset quality terms, considering that we are 18 months into a pandemic that's completely changed our way of life, certainly our way of doing business. So my first question is, do the NPLs and asset quality figures of the moment really reflect the reality of the impact we can expect COVID to have, or is there still a reckoning to come when monetary policy, government support gradually eases off and some of the liquidity goes from the system? Second question relates to neobanks and specifically your 811 business. Just very interested in what you're learning from that business so far and how you expect the environment for operations like that to evolve. Thank you very much.
Sure. The first one is relatively easier, Chris. And, like I started off by saying, one of the big learnings or outcomes of this entire COVID phase, you see the last 18 months really, has been the fact that the corporate sector per se has been very marginally impacted. Yeah, if you look at all the past disasters, the NPL disasters, and then we've had something or the other as an industry once every 4 or 5 years. They were all primarily led by corporate companies. This time round, touch wood, we've not had any real corporate getting into trouble. Part of the reason could be because all the people who had to get in trouble in any case had gone into trouble beforehand. So what we were left with was only a small number of trouble potential. Or the corporate sector was in a position to get equity much faster than in the past and hence stabilized pretty well. And if you look at the total picture, roughly about 40% of the total assets are in the corporate sector. So if 40% you see close to zero trouble, then you have something which is much lesser to live with. And again, something which is true for the banking sector per se, all of us provided pretty well right in the beginning in terms of COVID provisions. Yeah. And then one of the potential trouble areas, which was the MSME area, I think the government was forthcoming pretty much well upfront in allowing that flexibility to the ECLBs. So that gave a lot of breather to the SMEs. So that stabilized the SMEs. What it left really was the consumer pieces to take care. Normally in consumer pieces, unsecured gets into trouble faster, which is what did get it. The secured ones take time to get. So net, you've not really seen as much as what one would have probably expected as disaster when the whole thing started. Having said that, the wave 2 was a surprise, and it was, an unpleasant one. And we saw some trouble come back again, but a lot of the trouble still was relatively retail commercial and not at all again on the. So that helped. We still have to be worried about wave 3 and the future. But even when you look at the situation at the corporate side, you really don't find really too many stress cases. That's a big problem. That's part one of your question. The second one, you see, the customer behavior is changing. Yeah, the customer is exposed to convenience of a very different form today than what he or she was 2 years back. And frankly, COVID has only hastened that behavior in terms of expectation of far higher convenience. So digital is in, undoubtedly. All of us have to change. For us, 811 was our strong traditional acquisition. What we've done really is, in addition to it being just a sheer digital acquisition engine, we got to move beyond acquisition to engagement. So a lot of the digital work now for us is really engagement. Yeah, and that's where, between collaboration and competition with the neos, I think both of us will do well. But ultimately, the customer expectations have changed. All of us willingly have to change and change fast.
Great, thank you very much.
Thanks, Chris. Alec?
Hi, Mr. Gupta. You did mention about being circumspect about the third wave. Given that in mind, how much are you budgeting for credit growth for this financial year? What's the target there? And also, would you looking at ramping up your COVID book, COVID provision book, and what would be the credit cost for the full year? Is there any guidance on that?
So like Jermin explained, we've not dipped into our COVID provisions at all. So whatever that number was, 1,200 and some crores, that 12, whatever that crores number still remains. And like I said, that's sort of a buffer which we want to wait and watch. On your first part of what growth to expect, like I said, all of us are revved up and ready to press the accelerator. But we just want to be cautious and see how it goes before you necessarily press the accelerator. So don't force a number out of us. But if touch wood, it is okay, we will have whatever growth one can digest. Yes.
To credit cost, where would you look at?
Well, Jermin explained, the credit cost currently is roughly about 1.3 odd%. Last year, the whole financial year, our credit cost was about 3.56. I'd say at this stage, difficult to guess, but hopefully the wave 2 part of the impact was relatively transient. So if I were to look at the whole year, I'd say it should be somewhere in between this figure. At this stage, it doesn't seem likely that it will go higher than where the first quarter is.
Okay. Thank you, sir.
Thanks, Alec. Subhashri?
I wanted to understand your strategy going ahead in terms of, boosting the profitability, given that net interest income has remained quite muted. So will it be mostly from the fee income like this time? And if yes, then how would you want to actually boost your fee income going ahead? Thank you.
Firstly, I don't know how you're saying net interest income is muted. Net interest income has grown pretty well. We are at a reasonably high NIM. It is probably the highest in the banking industry. So I think the challenge for us would be to keep up with these levels of NIMs and these levels of NIIs. But
It is
once
not
growth is
something
there, it will happen automatically. Like Jamin explained, over the last few quarters, the challenge was to deploy the money in credit. Hence, a lot of it was deployed in treasury instruments, so investments. And hence, your net interest income per se was relatively muted, though the risk was much less. The moment you move from those instruments to credit instruments, your net interest income automatically grows.
Yeah. So what do you think that would you expect the other income to contribute more, or will the net interest income? I mean, how is this mix going to be going ahead?
See, normally, directionally, both move similarly. Okay. So if NII grows, your other income also will grow.
Okay. Thank you.
Yeah.
Thanks, Avashri. Ritu?
Hi, yes, my question was answered. Just quickly wanted to reconfirm. You said the credit cost guidance for the year would be between 1.3% and?
No, I said last year we were at 0.84. This year, first quarter, we are at 1.33. It doesn't seem likely that we will go beyond 1.33. So it should be somewhere in between this.
All right, thank you. And I also just wanted to confirm, could you give the exact figure for slippages this quarter? You said it was around 1,500 crores?
50, yeah, that's right. 1530 or thereabouts.
1539.
Yeah, so somewhere around 1530.
Okay, thank you.
Thanks, Ritu. Anurag?
Namaste, sir. Sir, just wanted to know that in your life insurance business, you had anticipated a loss of 275 crore maximum, and it has come around 243 crore. So going ahead, also there is some sort of anticipation about losses. And now the FDI thing is already been notified. So are you planning to sell some stake also? And second question is related to gold loan portfolio. You have said that it's a very small portfolio. But like other private banks, you are also going aggressive on gold loan book?
No, that's a statement or a question, Anurag?
No, sir, I just want to ask about gold loan.
No, our book is very small. So
yes, sir. Yes, sir.
We're not going aggressive, but whatever opportunity is there, we could go after.
Okay.
It's a business for us, and we will do what opportunity is there within our risk appetite. But it's a very small portfolio currently. We think we can grow that portfolio. We will grow that portfolio.
Okay, sir. You means not aggressive, but yeah, you will grow it.
Yes. There is opportunity to grow in that. We will grow. And then see the insurance fees, like we had given a statement a few weeks back. Yeah, the expected losses are higher. You provide for, in addition to losses which hit you provide for, expected losses going forward also. There is a provision which you also make, depending on, people may not have given all the details of their claims. They may be in the process of coming to you. So all of those provisions we make. So at this point of time, it seems adequate given what we went through in wave 2. Yeah, but if wave 3, God forbid, happens again of a similar kind, then we will have to rethink all over again. At this point of time, all of what we've done is adequate provisioning based on what experience we've been.
Okay, sir.
Yeah.
Thanks, Anurag. Ashish, you're up.
All questions answered. Just a small thing. How much of the 1539 crore would be because of cash collection issues? You said a major part of it is because of that. And secondly, if this is the major part of the slippages, then how do you see the slippages going ahead? Like, would it be sort of normal going ahead?
Yeah, the hope is, Ashish, that it will be more normal than otherwise. And both sides are possible. See, one is customers who were not able to pay, and B, customers we could not reach, and hence they could not pay. This time there is a fair proportion of customers who we could not reach, and hence they could not pay. But all that part will get corrected over the next 2-3 months. So as you start reaching to those customers, they will keep paying. But the customers who were not able to pay because business models were impacted, businesses were negatively impacted, they will take more time to come.
So can you give a breakup between the two, sir?
Well, often I don't have a breakup between them. But you know, commercial vehicles falls in the category where business models have got impacted. But let's say tractors, you know, falls in the category, or MFI falls in the category of people who you cannot reach and hence you cannot collect.
Thank you so much.
It will be roughly 50-50. Okay.
Thanks, Ashish. I think that's it, Deepak. I think no more questions. I'll just wait for a bit, see if anyone has further questions. I think we can call it a close unless you all have any closing comments, Deepak.
No.
All right. Thank you, everyone. Thank you for coming.
Thank you, everyone. Thank you.
Alec has a question. Alec, do you have a question?
Yeah, I just wanted to know, out of the 552 of your recast book, how much was it COVID under the COVID circulars, the August?
Yeah, I'll give you that. First COVID about 226. Second COVID very minimal, about 10 crores. Balance is MSME.
Okay, thank you.
Thank you, everyone. Have a good day.
Thank you.